January 4th, and a new round of economic data was mixed. Good news on the labor front with two separate reports. Private jobs grew last month and unemployment claims were down again last week. Orders for U.S.-made goods rose in September. Business activity in the services sector beat expectations, while manufacturing slowed last month. And third quarter productivity plunged faster than any time since 1981. Responding to price pressures, the Fed said it would wean support for the economy by tapering bond purchases. And Mana, so far, investors interpreted the Fed's statement as no big surprise.
I think collectively, all these data points have been met with a shrug by investors. In some cases, the results they saw were expected, and accordingly, they just dismissed them. That would be certainly the case with the Fed this week and their beginning of the tapering process. The Fed also added that they still believe inflation will be transitory, which was taken to be kind of a dovish remark by the Fed this week. Supporting the markets have been more and more really positive earnings results for the most part. That changed a little bit today with Peloton just really falling out of bed. I think their stock was off 20% as they and others that were part of this Zoom trade, this lockdown trade, start to kind of reverse course. But whether it's the Fed, Tuesday night's election results, falling productivity, disappointing GDP, the lack of a deal out of Washington, a spending deal, nothing seems to move the needle right now. And unless we start to see really frightening inflation numbers start out again, or kick up again, or tick in again, or if we think some of these vaccine mandates really put pressure on the workforce, I think this will continue, the collective shrug that we've seen from investors for the last couple of weeks.
Yeah, I mean, I think the only interesting piece to me this week was the elections and how, as always, it seems, right, we swing back and forth. And I think that the, Youngkin, I don't know how to say his name, winning down in Virginia, I think that was slightly surprising to some. And Chitterelli almost pulling it out in New Jersey, but not actually doing that. And I think, across the smaller local races, I think that it's swinging a little red. So not totally surprising given everything that's been going on. And I think one thing that's kind of a complete wild card for me is this vaccine for kids thing, right? And if there's anything we've learned is that when you start messing with people's kids, they stand up. And I think that's what you saw in Virginia. So it'd be interesting to see, like, people have been avoiding San Francisco or moving out of San Francisco, and they've been kind of going more with the work from home and all this other stuff. And if it just continues down this path of more mandates and more restrictions, and especially involving your kids, that's a little worrisome to me. But that doesn't mean anything for the broad stock market. It's just kind of anecdotal what I've been seeing.
Well, you gave me a couple of things to react to, Joe. The greatest part for me, not from a political point of view, but more of a human interest point of view, was that election result in New Jersey, where the trucker who had spent all of $153 on his campaign split between, I found this terrific, Flyers and Dunkin' Donuts. So I don't know if that was split evenly, $72 on Dunkin' Donuts and $72 on Flyers, but he knocked off, I believe, the head of the New Jersey State Senate. And, that was kind of unbelievable that a guy who really was known by nobody came in and won that election. So that was a big surprise, along with some of those other things that you referred to before. Going down to this lockdown thing, I think what we have in New York right now is a little bit of a petri dish right now, right? We saw some things go into place where those in New York would not be paid and could not work, city workers, that is, if they didn't have the vaccine, and that affects fire, police, and sanitation. So over the next 60 days, as Mayor de Blasio runs out his term, if there's no loosening of that, we will get a sense of what that means to the quality of life. And maybe it means very little. Maybe there's enough guys out there picking up trash and fighting fires that it will be a big nothing burger, or maybe it will seriously impact the quality of life. And If it does, I think there'll be a lot of pressure on the administration in Washington to kind of postpone this again. If it's a nothing burger, and I really don't know which way it's going to go, then I think, these mandates will come into place. Lastly, you talk about the kids, and, I don't have any kids under the age of 18. I don't have any grade school or high school kids anymore. And I'm not sure what I would think if they wanted a kindergartner of mine to get the vaccine. But from an economic point of view, if this is mandated and people in large numbers choose not to have their elementary schools kids vaccinated, that's going to keep more people out of the workforce and put more wage inflation in place and make these labor shortages we've seen even more extreme. So I'm not taking a political position on any of these things, just trying to lay them out kind of as I see them and what the next 60 days may look like.
So the overall CMBS delinquency rate hit a new milestone, dropping below 5% last month for the first time since April of 2020.
So this has been of a piece that really started over the summer of 2020. We saw two enormous spikes in the delinquency rate in May and June of 2020. And ever since then, 16 months now, we have seen that rate go down. This was one of the bigger drops that we've seen. In fact, it was the biggest drop since February of 2020. The delinquency rate falling to 4.61%. That was a drop of 64 basis points from the September number. And for those that are looking beneath the surface, sometimes when you see the jobs number, there are mitigating parts of it, where the jobs came from, seasonal impact, and so forth. This particular delinquency number, was good from top to bottom. When you look at the percentage of loans in grace period, meaning loans that the borrower missed their payment but are not 30 days delinquent yet, that fell below 2%. That number at one point was astronomical back in the early COVID days. So that particular number dropped 36 basis points for this month. The percentage of loans in special servicing fell from 7.5% to 7.17%. So more improvement there. When we look at property by property type, this was really interesting for me. Across the board, real solid improvement for every property type, with the biggest gains being in the most unloved segments. So leading the pack, hotels, delinquency rate there fell by 141 basis points, now just over 10%. Listeners will remember that at one point that number was about 25%. Retail delinquencies down 140 basis points as well. The overall retail delinquency rate now 8.39%, as that just continues to tumble. Multifamily, well under 2%. Industrial, it dropped again this month. The overall industrial rate is only 53 basis points at this point. And office delinquencies, they too fell below 2%. So really nothing you can look at in this report that has any kind of storm clouds around it.
Another shrug of the shoulders from the broader market, right? Things just keep getting okay. And I think maybe what we'll do next week is, usually at the very end of the month, we release the delinquency report, and then we have a few other things that come out, like the loss report. So sometimes I wonder, when you see lodging drop from 11.45% to 10.04%, how much of that is coming from cures, right? Loans going from delinquent to not delinquent versus loans getting disposed of, right? So I do know that we're starting to see some more disposals, and we talked about that lodging loss report, I think, last week. So we should take a look at that to see where these drops are coming from.
Well, I would add one more point to this, one more green shoot, if you will, to this report. And that is, in recent months, what we have seen is a reduction in the percentage of loans with a special servicer, leading to an uptick in the balance of loans or the percentage of loans with the watch list. And the reason for that is something on special servicing with a special servicer, with the workout specialist. Once it has been resolved, it normally goes back on watch lists and it sits there for a while. So let's say that a loan was sent to special servicer with a desire to be restructured because a tenant was lost and DSCR was under 1.0x. The borrower might get some kind of relief out of this or some kind of accommodation. Once that happens, it's usually that the loan goes back to watch list because DSCR is still low, right? So, and there it resides. So what you saw was a lowering of the special servicing number, but an uptick in the watch list number in recent months. This month, both went down. So what we're starting to see is those loans that went from special servicing to watch list are now coming off watch list and are going back to just straight performing, not loans of concern. It was about 100 basis point dip. Between the two, special servicing and watch list, it's still a very high number. It's in the high 20% range, but that's a positive sign. It just means that the market continues to heal.
Turning to the office sector, we saw a number of stories that show some positive green shoots in that space. Colliers released a report that said the Manhattan office leasing market has notched its most successful month of leasing since January of 2020. And another article commented on the fact that the top of that market is doing well as employers are trying to lure workers back with amenities and other things, which means they're having to dig into their pockets for higher effective rents. So a couple of positive stories as that office market starts to pick up.
We did see some mostly nice comments from Vornado with their earnings release this week. They did sign almost 800,000 in new office leases in Q3 as part of their earnings announcement. That information was released. A couple of things that I thought were interesting out of this. They said that they got a 500,000 square foot renewal from the Interpublic Group, which is advertising. That particular space is by Macy's in Herald Square, where the Thanksgiving Day parade ends every year. And advertising to me strikes me as something that it's kind of like law firms and accounting firms where you might have seen some kind of retrenchment, where they're looking to give back 200,000, 300,000 square feet. So to me, this is a really nice green shoot that they were able to nab this renewal. They also added another, I think, 75,000 square feet for Google at 85 10th Avenue, which is a space that used to be occupied by the GSA. It was a government lease. They vacated late last year, something we wrote about in our TreppWire, and Google has now taken part of that space. And just today, in the last 2 or 3 hours, Vornado also announced that they had signed on Clear for 120,000 square feet at that particular property as well, 85 10th Avenue. Clear are those guys, when you walk into the airport, if you've paid a certain fee, you can go there and have your palm read or your retina scanned to get—
They read palms?
No, they read thumbs. For some reason, my retina doesn't scan very well, so they always ask to see my thumbs, and that's how I get through there every time.
I recently had a conversation online because I was in TSA pre-check, and the people from Clear just cut you, right? So I turned to the guy, I said, "What's the deal with Clear?" He's like, "Oh, well, you pay a little bit and you whatever." I go, "I just know the moment I pay for Clear, there's going to be a Clear Plus that they come out with. And then there's going to be people cutting me still. So I think I'm done. TSA pre-check is as far as I'll go."
Well, I've been a user of Clear for a long time. It used to be, it's the easy pass basically for the security line. It's even faster, I would say, than TSA. Although I have to say, when I came back from Las Vegas in September, the Clear line was longer and slower than the standard TSA. So it seems like, and part of that I think is that the technology is good, but not great. It always takes a couple of seconds for this whole thing to work, and that kind of slows you down. But in the beginning, when you were the only guy with Clear, it was quite a coup.
So I know we're meandering here, but we had a few other office stories, including a deal of the week, right?
We did have a deal of the week, and this one I love because, as listeners know, I love unloved parts of the market, ones that have been struggling, property types or geographies that have been struggling because of COVID or because of overbuilding or because of the nature of their local economy. So this one's a beaut. Shell Oil renewed for 260,000 square feet in Houston. Houston, for those that read our research and those that listen to the podcast and those that have been reading our research since 2015, know that that has been a mess. We've seen some big office losses, places where the entire office property was either single tenanted to an energy tenant, or the energy tenants, made up 90% collectively of all the office space. So we've seen a lot of problems there. BP has retrenched, Conoco has retrenched, others as well. Here we have Shell renewing for 260K, and it came a couple of years ahead of their lease expiration, which was supposed to happen in 2025. The property is 1000 Main, and Madison Marquette's Wade Bolin represented Union Investment. They are the landlord in the deal. Apologies in advance for these next couple of pronunciations. Tim Relia and Joseph Petty with CNW represented the tenant, and the news came by way of the Biz Journals of Houston. So a great deal of the week there.
Yeah, and we had, I guess, what you would dub a must know, which I think we wrote about this morning or yesterday, which is Amazon is targeting Jersey City for major office expansion, right? So Long Island City said no, so they're going to Jersey City.
So what we're talking about there is they're looking for 400,000 square feet, which is an enormous amount of square footage on the Jersey City waterfront. The building that they were targeting is known as Harborside 1. It's a Mac Cali property. Bloomberg broke the story, I believe. That's what I'm looking at here anyway, a Bloomberg story. And, our must-knows that we bring up from time to time, since the ink is not dry yet, and I guess there's still a chance that Amazon looks for something other than One Harborside, is for those brokers out there that have big parcels of space in a particular geography, to make sure that they at least make that phone call to Amazon to see if they could still get into the game. So that's what we try to do with our must-knows. And that was a biggie from this week.
And a trading alert that raised alarm about a bankruptcy.
So this has been out there for a while. HNA Group, which is a Chinese organization, bought up a bunch of properties in the U.S. Between 2016 and 2019, give or take. And they later looked to get rid of those as they ran into liquidity issues and had other ongoing concerns. The news this week, and this came from Crane's Chicago Business, was that one of their subsidiaries filed for bankruptcy. The subsidiary is PWM Property Management. It has stakes in 245 Park Avenue. That is a 1.7 million square foot office. It secures 826 million in CMBS debt split across 15 different deals and notes, including one single asset deal. The problems for that particular property seem to begin when the office lost Major League Baseball a couple of years ago. They had a big lease at the property and they moved to the west side. That led to some concern. PWM's manager, SL Green, has not been able to replace MLB, and there's concern that a cash trap will be put in place for this asset that will cost PWM the ability to pay dividends at the corporate level. PWM also owns 181 West Madison Street in Chicago. That's 950,000 square foot property, backs a single asset 2020 deal. So how this plays out, this bankruptcy, remains to be seen. Will PWM look to sell the properties? Will they look for some kind of modification? What happens here? Hard to say. Both loans have considerable time to go. So this is not a type of thing where an extension is needed in the short term. So stay tuned.
This seems like one of those stories where it's not necessarily the properties that have lost a ton of value, right? But it's the the distress is coming from the actual borrower, right? I mean, obviously the MLB lease is a big deal, but that's 245 Park is right next to Grand Central on Park Avenue. It's a good spot. So
It's a great spot, great location. For those commuting into Grand Central, doesn't get much better than that. You barely have to go outside in the winter to get to your office. But the other thing, the other side of the coin, if you will, for that particular market is you have One Vanderbilt, which just came on, which is a huge building, which has been attracting just really high-level tenants paying top dollar rents. And you also have the situation where JP Morgan at the moment is spread all around that Midtown Park Avenue corridor as they build their new headquarters. And once that headquarters opens, you think they pull back at a lot of these temporary offices, and that may put pressure on the rest of that 245 Park kind of neighborhood. So, but I agree with you. I think that, these things are trophy assets in normal times, and they're not the kind of thing you're going to get for pennies on the dollar.
I will say that one of my many celebrity sightings in Midtown over the years was in the lobby of 245 Park Avenue. I was going to see a client, and there was Rob Manfred walking right by. I actually went to high school with his son, but that's a whole nother story.
Did you try to get yourself a tryout? Did you try to get, do you still have that gun that you used to talk about?
My arm is still sore, I think, from high school. By the way, if anyone, I'm sure there's a lot of people listening who are, Midtown Manhattan people. The steel structure that is being built for that JP Morgan building is just unbelievable to see. It's like, to me, it's a marvel how large and kind of interesting looking it is. So now that we're commuting again, I'll get to watch them build that building, 1 week at a time.
Turning to hotels, our team is reporting that they're seeing an increase in activity in the hotel sector.
Yeah, we'll run through a couple of deals that came out over the last week or two, and then we will tie it together with a theme at the end. Maybe you can identify the theme before we get there. That is our listeners. The Biz Journals of South Florida reported that East, Miami, that's the name of the property, East, Miami, hotel in Brickell City sold for $174 million. Swire Properties sold the asset. Trinity Real Estate Development was the buyer. It equates to about $540,000 per room. The Four Seasons Hotel in Napa hit almost a record valuation. This is an 85-room luxury hotel, $2.1 million per key, total price $175 million. Hotel Aspen, this came from the Aspen Times, the previous story, by the way. Four Seasons Hotel came from the Wall Street Journal, and it was also tipped off to us by one of our listeners, Joel. Hotel Aspen, this comes from the Aspen Times. It sold for $37.5 million. AC Hotel, the Boston Downtown Marriott, sold for $89 million, $434,000 per key. I might have mentioned this one last week. So what is the theme here of all these things that we are seeing? The theme is these are really all drive to travel luxury destinations, or in the case of Boston, just a red hot market, right? Red hot in the health science space, right? What you're not seeing on this list is at this point, the big New York City sale, the big Chicago sale, things like that, anything that is business travel centric. And until we see that, it is a tale of two markets. We did talk about the story a couple of weeks ago where somebody was putting out a Chicago hotel for sale. I think that you'd call that testing the waters. So for right now, it's coming back to be a very, very good market if you have this drive to luxury, high-end destination. And that's great to see for that part of the market. Still want to see New York, Chicago, and some of these other ones turn around.
Yeah, other side of the coin was the New York Post story this week with the headline, New York City's catastrophic hotel crisis isn't ending anytime soon. Some of the highlights or lowlights from the story was of the city's total 700 hotels pre-pandemic, about 250 either closed or were converted to homeless shelters. Average occupancy fell from over 80% in 2019 to 33% earlier this year. I don't want to add insult to injury or rub salt in the wound there, but you're not going to see the NYC hotel industry come back until you get tourists back, right? And for tourists, you need Broadway and you need restaurants that are, very open, right?
I would add to that you need people in the offices for people not in New York to come visit.
Right.
Salespeople, vendors, other industry people, deal makers, and so forth. That that too is a big part of the equation. We've seen virtually none of that. I could be mistaken, so I'll say this with a grain of salt. We just have to go back and look at those Vornado earnings again. I thought that they said that they were still under 50%, if I'm not mistaken, on physical occupancy of people coming back to the office. And now that we're 2 months after Labor Day, that's a disappointing number. Don't hold me to that number. It's kind of...
No, it's not surprising given the numbers we've been seeing from other outlets that have it at like 30% or 28% in New York City.
One thing I'll throw at this just to close the New York City hotel segment is that this gentleman was quoted. This article was by Steve Cuozzo, who does a great job writing for the Post on commercial real estate. He's been around a long time. He quoted a gentleman there, and I think it was, if I'm not mistaken, the head of the hotel trade organization. And his remark was he doesn't see business coming back to 2019 levels to 2025, which is just a real kick in the teeth for New York hoteliers, and it's disappointing to see. We did have a couple of other green shoots out there that I'll throw in there, new developments that are coming out there. We'll run through them one by one. There's a Four Seasons coming to Jacksonville's riverfront area. This came to us from Resident News. It appears that the owner of the Jacksonville Jaguars is putting together a $300 million complex. He got about $100 million in incentives from the city. It will include a 176-room four-season hotel with some condominiums. And, good to see, development happening in Jacksonville. I mean, Jacksonville's like Tampa and some of these other cities we've highlighted in the past, a lot of inbound, a lot of businesses flocking there from New Jersey and elsewhere in the Northeast. And, this is where hotel developers are going to build. In Indianapolis, they're going to convert a former sports medicine complex into a 125-room extended stay hotel that comes from the Indianapolis Star. And then to close on a partially high note for New York City, they're going to open a new Hyatt on Central Park South. This is at West 56th Street. It's a 729-room hotel that $100 million was poured into it. So this comes from the Biz Journals as well as the Wall Street Journal. I guess that's a good sign. On the negative side, it's more inventory for New York at a time where they don't need any more inventory. On the positive side, somebody is saying we're going to make a bet on New York that it's going to be coming back. So I'll look at the glass half full, and that's how I'll end it.
Turning to retail, we had a couple data points that you were going to call attention to.
So a couple things. We saw a couple of, one good thing, one bad thing. For those looking for a data point on mall values, there was a story from Commercial Observer that said the Burbank Town Center in the Los Angeles market of California was being sold to the Ani Group for $136 million. That property was valued at $240 million back in 2006. So is this a good story or a bad story? I would say it's a good story, even though the value has dropped by more than 100 million. Number one is you don't see things with falling value trade for, almost 140 million very often. This is a high price. This is not a $20 million sale to a Namdar or a Hull or a Cohan, right? This is real money, $140 million. So this is a big bet by Ani on this particular market. And I think it's also nice to see that, it's all relative, but, this is about 60% of the value of what we saw in 2006. It's not 30% of the value. So for those looking for metrics to see where distressed malls should be priced, add this to your list. On the negative side, in Portland, the Lloyd Center is being foreclosed upon. This is not a CMBS deal, but Oregon Live was reporting that KKR has said it is looking to foreclose on the property, and there's $110 million in debt that's been overdue for about a year at this point.
That one, I was wondering if it was in a CRE CLO, because a lot of the KKRs and Blackstones and them, they put these loans on CLOs, but I don't think that one made it in. Must still be on the balance sheet.
It could be. I didn't look that closely, but that would make sense.
I just looked. It was in an old CMBS deal back in 2006, but no longer, as far as I can tell.
If we want to leave with a green shoot, we've talked a lot about New York today. It's showing our geographical bias. I'll throw one out there to just leave people again with something of a high note. Again, this one goes to the New York Post, Lois Weiss, who along with Steve Cuozzo makes up a nice 1-2 punch in the commercial real estate space. You know, I think a lot of people think of the New York Post for their page 6 and their outstanding sports section, but they do a nice job with their commercial real estate, covering New York City leases and sales and so forth. Lois was saying that we're starting to see retail spaces start to be absorbed a little bit. It seems like retailers are, in her words, ditching old uptown for hipper spaces down in things like the meatpacking district and so forth. She picked up a couple of leases that she honed in on. Givenchy, did I say that right? Givenchy? It's opening up.
That would be Givenchy.
Whoa.
All right, say that again for me.
Givenchy.
Givenchy.
French designer.
And what is it? Handbags?
And other things.
Perfume? Footwear? What do we got?
Designer.
Something like that.
Designer stuff, man. You probably don't have any in your closet. I'm
Lady
thinking.
stuff, man.
Yeah.
I don't, I rarely walk into places where I can't get things like 3 suits for, $90 at a machine washable. But so apparently Givenchy is opening a store in Soho on Green Street. And Jonathan Adler, another person for whom I don't know what they make, is opening a store on West Broadway in Lower Manhattan. And in the meatpacking district, Gucci, that's handbags, took 27,000 square feet on West 14th Street. So some green shoots happening. We've talked before that New York City retail has been a bit of a dumpster fire. Nice to see people betting on that coming back.
Well, I know you're trying to end on a green shoot, but I think the uptown to downtown move is I guess something that's happening, but just in our experience, kind of in the Midtown area, especially on Madison Avenue. I mean, these are stores that used to be Cartier and upscale, food places and other things. And now it's mostly empty. And then the one store that I always notice is it almost looks like a Marshall's or something. It's like 50% off clothing come in. It's just laid around on tables. You know what I mean? So it's a little bit scary kind of walking down Madison Avenue and looking at some of those retail storefronts.
Well, it's funny, next to the Cartier and other places like that, you'd always have that knickknack store that was going out of business.
Forever.
And as my dad once said to me when I was a kid, as we walked by one of those places, that store's been going out of business for 40 years, right? And it's selling the New York City hat, the New York Rangers t-shirt, the metal, knickknack of the Statue of Liberty or the Empire
Zippo
State
lighters.
Building. Zippo lighters, right? It's really an interesting part of the market for sure.
We had a number of shout outs. I will run through them quickly. Srinivas Y, Blake L in Houston, Owen F, Brad L, Adam B, Adam W, Martin K, Mark E, David K, John C, and Black Eagle tweeted at us. So a good number of folks actually were interested in what we covered last week with the loan modification, as well as the stuff that Arrest covered with the quarterly data report. A number of people wanted a copy of that.
Yeah, I think we had a record-breaking number of people come in looking for that modification document. So thank you for all those that reached out to us and the kind words that you offered when you made your request.
In closing, McDonald's is creating its first ever, and we talk about NFTs all the time. So McDonald's is not going to be left behind. They've developed their own NFT token in honor of the McRibs 40th anniversary, if you can believe that, guys. So they'll be giving out NFTs to fans on Twitter in a sweepstakes. and it'll run till November 12th. You'll need to have a crypto wallet in order to receive the piece of art. So time to open up that crypto wallet if you don't have one.
Does Givenchy sell the crypto wallet? Or
No,
Gucci?
but Gucci has one.
That would be
I would
funny.
say if I could replace my normal McDonald's purchases with McDonald's NFT purchases, this COVID 25 that I've put on might come down a little bit. My cholesterol might benefit there.
My slice of this week was, this was a story from the Inside Hook, which I don't think I've ever quoted before, but they said that Nike wants to sell virtual sneakers to wear in the metaverse. And that really made my head spin on so many levels. You know, from a commercial real estate point of view, does that mean they're not going to be selling bricks and mortar sneakers anymore? Is that out the door? Is this a negative for Foot Locker? If you buy a virtual sneaker, does it wear down if you walk down the virtual sidewalk? I don't know. All I know is that if I'm going to jump into the metaverse, I want there to be real tangible benefits. I want a metaphysical, open heart surgery to clean my arteries. I want a, metaphysical cortisone shot to fix my knee.
Dennis,
Right.
In the metaverse, here it is. This is all you need to hear. In the metaverse, you can dunk.
Nice.
I want the real thing though. If I eat a hamburger in the metaverse, I want my taste buds stimulated. And if I go to the metaphysical gym, I want to come out with a 6-pack in real life.
That's
Only when
explaining
that's
the
available.
Matrix and not the
Only when that's
metaverse.
available.
It's gonna go.
But here you
funny.
go. What we got to worry about brick and mortar retail. We might have to worry about industrial now. If everything we're buying is going to be meta, then who cares about the supply chain or the distribution centers, right?
I'm gonna go put on my virtual sneakers and eat a NFT McRib.
There you go.
Right. Nothing means anything anymore. So doesn't
That's
matter.
right. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email to podcast@trepp.com. And for more information, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.